This episode will be a rare opportunity to get an insider account of the hedge fund industry with someone who's been there, who's launched his own hedge fund and had a very successful career as a quant, Richard Saldanha. But at the same time, now he has some distance to the industry and can provide an unbiased perspective as he has embraced a new career as an academic and consultant. And this is the second part of the interview with Richard. We already released an episode about his perspective on AI in investment management. And we resume here with an existential question I had regarding data. Something that surprised me, I thought data was kind of commoditized, especially financial data. You just have to go to the providers and source what you want. Marco Abwab, my previous guest, was telling me how hard it is, and I would say that he was describing it a little bit as picking the right fruit at the market, this finding the right data, finding the right provider. So it seems like not just the abundance of data, but the quality of data is a challenge and maybe a big opportunity as well for someone who is in data.
Well, I mean, absolutely. If we talk about financial data, what type of data are we talking about? Are you saying you want closing market prices for liquid equities? That's easy, but beneath the surface, there's a huge amount going on. I mean, there's an entire order book. There's tick-by-tick trading. If you really want to get at what's going on, you need to elucidate the order book. You need to get hold of tick-by-tick data. You need to be able to analyze those data in the right way. A lot of people trade in the closing auction. Do you know what happens in the closing auction? Can you get at those data? Well, actually, the exchanges will sell you those data. Quite pricey to get at that information. And no one is going to tell you what's right or wrong in terms of elucidating those data. It's up to you to sort of analyze it. And that's where us quants come in, because we're very good at coming up with seemingly plausible reasons for why certain models sort of work and others don't. Whether we're right or wrong, well, the proof is in the pudding, of course. If we build a trading model and then we sort of apply it, does it make money or not? It's very clear from that point of view. And I rather like that. And that's why I chose finance, because you have immediate feedback in terms of what you've built. But no, I mean, hugely important, the sort of input. We're back to the input. So garbage in, garbage out. You need to make sure that you provide the right input and at the right scale. So if I really want to know how something is traded, I want the ticks, okay? And by the way, the ticks don't occur at precise, discretized moments in time. They're all over the place, of course. So, time is continuous, but models tend to be discrete. That's how we sort of describe them. So we've already got a mismatch. And then, of course, as a statistician, it would be wrong if I didn't mention George Box's famous aphorism that all models are wrong, but some are useful. And that's as true now as it always has been.
That brings a question related to your hedge fund past. Also, this previous conversation, I also talked to Greg Zuckerman, who wrote the book about rent tech, Jim Simon.
Yeah, it's a great book.
It's a great book, yes. And they talk about how they build the data, how the people are very important in the model, even there. And it's maybe also a very fair business model, this hedge fund, because, well, yeah, like you said, the proof is in the pudding. If it works, this performance, then you keep playing. If not, you stop. What was your personal experience on it?
Well, as a quant hedge fund manager, we were searching for market inefficiencies. We don't believe in the efficient market hypothesis. People do all sorts of things. And one model that I had quite a lot of success with was currency carry. So you buy the high yielders and you sell the low yielders, and that seems to work. You'd say, well, that seems completely ridiculous. Why should that work? And you think about it and you realize people exchange currencies for all sorts of different reasons, very often in an inefficient manner. If I'm a business owner, and my income is in dollars, but I'm based in the UK and my costs are in pounds, then I'm sometimes forced to exchange at perhaps the wrong rate. One can potentially benefit from that, provided that you've got reasonable risk management in place. But that model, the idea of carry, in this day and age, most people know about this thing. It shouldn't really work. The underlying model is sort of covered interest rate parity, that there should be no arbitrage there. Well, it doesn't actually hold in practice. So that's what we do. We sort of search for inefficiencies in the market, and I assure you that they exist. We try and exploit them to our benefit, i.e. can we make money with them? And then it's hugely competitive. I mean, I can't compete against an investment bank that might be doing this on a huge scale. And so their arbitrage bands are much narrower than mine. I need bigger margins in order to trade all this sort of stuff. So all these sort of things sort of feed into the development of a trading strategy and an attempt to make money out of the market inefficiency that we spot. And, it's fickle, right? How many times have we seen convertible arbitrage be the darling of the hedge fund industry, only for it to collapse in a year's time as everyone flocks to that strategy, and then it becomes global macro or statistical arbitrage, etc. We're on this merry-go-round and we play these games. So diversification is key, and I think we go back to Renaissance technologies. I think they solved or found a lot of these inefficiencies before many other people did. And so they were ahead of the game. And I think lots of quantitative hedge funds do lots of similar things that Renaissance technologies do or did, but Renaissance were sort of ahead of the game. And by the way, I believe that everyone in the data room at Renaissance technologies had nothing less than a PhD.
Absolutely, yeah. No, it's an amazing bunch of people, PhD. And what's interesting as well in what you said is it's fickle. And there's this level of adaptability, right? And Renaissance, if anything, makes them as stand out is their adaptability and how much effort they put into that and how worried they are that everybody else is going to eat their cake.
It's not one model. There are multiple models is really what I'm saying. So what you tend to find with quantitative hedge funds, certainly fledgling hedge funds, they have one strategy. They try and get that running, and then if they're successful, they develop a second strategy, ideally, that isn't too highly correlated with the first, and then you've got the makings of diversification there. The other thing that Renaissance did, which is hugely important, is they limited the size of their fund.
Yes.
They didn't allow it to grow out of proportion. We can compare and contrast Rentec with LTCM.
No, that's what makes it interesting as well from many angles, right? From a performance persistency point of view, how they managed to solve that, and from a very human perspective as well, because I think it's so hard when you're successful to limit your age, and they're hugely successful. I think I calculated that if they had reached, if they had opened the gates and charged 2 and 20, they could probably have made, with a lot less performance, maybe maximize the amount of money or kind of a break even in a different way.
But Medallion is not open to external investors.
Yes.
I think they've got 1% sort of legacy money there. Eat what you kill.
Yeah, I think that's what they were doing. I think after I'm going to go back to this AI, but to enlarge a bit in hedge fund, because that's a reflection I have in terms of portfolio construction, alternatives. It feels to me that when we talk about alternatives, again, I was working at an alternative conference. Now people talk about private equity or private assets, right? And maybe hedge funds have fallen behind in terms of assets. I mean, they're growing in assets, but not as fast as the rest of markets, and perhaps I can see as well a little bit of bad press, perhaps very much justified in terms of the fees versus that. My question is, well, basically your opinion in terms of where hedge funds are today.
Well, once upon a time, I mean, when I sort of came into the financial markets, I joined Lehman Brothers in 1997. I resigned in 2001, sold my shares at $85 each. So I take my luck where I can find it. At that time, hedge funds were all the rage. Everyone wanted to be in a hedge fund. There were an awful lot of hedge funds that weren't doing anything that was particularly novel. They were charging 2 and 20 for that. A lot of those strategies, so momentum, short-term reversion, those sorts of things, they're effectively commoditized now. And I think a firm that I'd cite as being nimble on their feet is AQR. So Cliff Asness and David Cabela and those guys went from being a pure hedge fund. I met them in Connecticut way back. And they went from being a hedge fund to becoming more of a mainstream asset manager, and have been very successful, have a very successful operation. If they were a hedge fund, they'd be one of the largest hedge funds around. But they've become more mainstream. They were very honest about what they had under the hood, and you can pick up standard strategies for a lot less. I can't remember exactly what their fee structure was, but certainly they weren't charging 2 and 20 for a lot of these things. Asset management, as you know, the traditional asset management business doesn't charge an incentive fee. You've heard of hedge fund managers labeled as greedy from that point of view. What are they charging for? But it's up to the market to decide. You need to decide whether the hedge funds that you want to invest in are actually providing you something of real merit. Is it genuinely something novel? Are there real barriers to actually implementing this thing yourself? What are you getting? There are some fantastic hedge funds out there. I've allocated to hedge funds in the past. I like to think that I know what I'm doing.
Yeah, no, but there's this democratization of alternatives because you want uncorrelated stuff. It would be nice as markets correct to have something that brings true diversification. And yet it seems like the whole democratization is going through this private credit, private equity. Those are the assets that are booming, but it's hard to, even from a theoretical point of view, understand how they truly diversify between equity and private equity, whereas hedge funds, at least in theory, could offer that. So I'm thinking like, is the hype gone too low in terms of hedge funds?
It's grey. Most things are grey. There are some stunning hedge fund managers out there. There are some stunning private equity managers out there. A third pillar that you haven't really mentioned is passives, the rise and rise. When I started in the industry, we had the cubes and the spiders, and then there was the birth of European ETFs, etc. There has been an absolute explosion in terms of exchange-traded funds. Personally, I love exchange-traded funds. My personal investing now tends to be ETFs. That's sort of my go-to. The ability to choose, you can choose so many diverse strategies within ETFs that you can construct a very novel portfolio out of a set of ETFs in itself. So I think that actually has eaten the lunch of some of the hedge funds. And by the way, hedge funds are generally not the preserve of the ordinary person in the street, whereas ETFs are used both by individual investors, ordinary people, as well as institutions in terms of investing. So that is, I think, the real democratization of the investment industry. Now, coming back to your question, you asked me about private equity, hedge funds. Well, the lines are a little bit blurred, but largely with private equity, you need to know what you are dealing with here. It's not the same beast generally. These are not daily traded securities. These can be very opaque investments. They're very often investments in infrastructure, long-term developments, etc. Very worthy investments. Maybe you're helping a less developed country build roads, dams, power infrastructure, all this sort of stuff. But, I've got to effectively invest and market to market in some way. And that market largely doesn't exist. It's a bit like owning a house. How much is your house worth? Well, I only really know it's only based on what somebody is willing to pay me for it. It's the same sort of idea with private equity. And I think in private equity, we play a bit of a game with ourselves because the private equity manager will say, well, have I got an investment for you? Maybe it's a nuclear power station. Let's say in South Africa. South Africa has one in Cape Town, but let's say they want to build another one, and it's a private, and the government don't necessarily want to fund it all themselves. Private equity investment, have I got an investment for you? Here's the investment up front, and then here are the cash flows. And I'm going to measure these cash flows for the next 10 years on a quarterly basis into the future. And there's this game that everyone seems to play whereby those cash flows are treated as if they are precisely known, that they're measured without any variance. That, frankly, is a complete nonsense. And so the idea that I can come up with an internal rate of return for that investment now, known precisely at this moment in 2025, but in fact this thing is not going to mature until 2035, is sort of utter nonsense. I have looked into that as well. And then there's all this illiquidity characteristics around this. Maybe I've invested in this nuclear power station in South Africa, but if I want to liquidate that investment, who's going to buy it? And there's lots of fun and games that sort of go on in private equity. So in it, there are plenty of irregularities we've seen it with developed businesses, with mature banks, etc. They get things wrong. They get sanctioned by the regulators. We've seen it with hedge funds, certainly. Shall I tell you a story about me reviewing a hedge fund in New York with a business partner of mine? We went to see a firm. It's a firm called... It was headed up by a chap called... They invested in US single stock options. It was a tower block, a large building in the middle of Manhattan, 23rd floor, and they outlined their strategy, and they had their risk management people come in, and so on and so forth. Literally, as we were walking to the lift, I turned to my business partner and I said, well, did you understand how they made money? And my business partner said, no. Furthermore, I didn't think that the market in single stock options, US single stock options, was sort of large enough to sort of warrant that type of trading behavior. So I said, well, they seem like nice guys, but we're not going back, are we? This is literally before the lift arrived on the 23rd floor. And he said no. And the next thing we read was that was on the run in South America, been indicted in absentia by the SEC. Wire fraud, an absolute disaster. They claim that State Street were their fund administrator. Complete cut and paste job in terms of letterhead. All one had to do was literally phone State Street and say, do you act? And they would have said no. The alarm bells are ringing. Do you know how much money they had under management?
I guess a lot, if you ask me.
Nearly $1 billion, mainly from European fund of funds.
Amazing.
Yes.
I think it's a really interesting perspective in terms of, okay, we democratize, and in a sense, ETFs have a really critical role to play. I think what you mentioned as well, we have to question really where the hype is and think carefully. And that brings me to another question, because we can think, and again, it's not about predicting where the market is going. We can think of this, there's been a major correction in 2022, and then there's this AI narrative that came to the fore, and we feel like the market's really driven by that. And all the companies have been outdoing themselves to say, hey, we're buying CapEx, we're spending tens of billions on NVIDIA and stuff like that. And, the DeepSeek, which changed a bit this narrative, or that you don't necessarily need hundreds of billions to develop this. Well, it might have triggered something. Again, it's not about saying where it's next. But what do you see as the CapEx arm race? And it's an arm race, it's almost between governments as well, right?
You can always spend more, is my answer. It is an arms race from that point of view. Also from that point of view, a company like NVIDIA, who effectively is providing the shovels to the gold miners, is fantastic, is from that point of view. And their technology is absolutely superb. And demand for their technology will continue. And I think NVIDIA has pretty much recovered from the sort of DeepSeek hit, as it were. And by the way, the technology itself, if I can compute faster a model that I want to implement, then everyone else will simply use that sort of mechanism, as it were. It's a bit like the attention mechanism. Before the attention mechanism, I had to train for longer. With the attention mechanism, I can cut down on my computation and get pretty much the same result, but in a much shorter period of time. It reduces my cost. You're benefiting from sort of model development, technological development in terms of hardware, costs are falling, etc. I just see this continuing. I don't think the spark of genius is more of the same, more compute, more data. But certainly people are going to compete against each other in terms of just sheer size, compute power, data volumes, all this sort of stuff. This is a reason why I don't think this is the preserve of governments. I don't think governments should sort of get involved in this arms race. I have heard it said, should the UK be producing a foundational model? So, essentially it's a large language model, but a large language model with multimodal capabilities. But to all intents and purposes, it's largely the same sort of thing. And I say no. Why don't you just leave it to the large tech companies to sort of do this? We can benefit from it, absolutely, but you're on a hiding to nothing, because as soon as the UK government, or any government, produces something, there'll be something better that has come along from someone else who's more dedicated towards it. Google will come out with a better version of that. Why would I use the UK government model?
Thanks very much for watching this. I hope you enjoyed this conversation. We have also discussed data science, quant investing, and AI with Richard. You'll see the link to this previous video. I hope to see you next time for another episode of Investology, where we'll be rethinking again about investment management and how to deliver better outcome for investors.